So if you have an expectation of what you think the market's going to give you, where you think the market's going to go, for example, I think your dollar is going to go up, or I think this is the trade that's going to help me get my funded account, right? Those are all outcome-based expectations. If you're going into the trade with the expectation of, I don't care which direction this position goes, I don't care if it goes up, I don't care if it goes down, I'm executing on this position because it aligns with my edge. I don't know if I'll win on this individual trade, but I know over a large sample space, I'll be profitable because I'm executing on an edge.
Welcome back, everyone. Today I'm sitting down with Pat Bailouni, and we'll discuss trading mindset. We'll discuss his story as a trader, how I went to become a profitable trader, and some tips for you in terms of mindset, becoming better, and improving how you see trading and your perspective on it. So, Pat, welcome to the podcast. How's it going today?
Perfect. Thanks so much for having me, Etienne. I'm incredibly excited to have a discussion today and share some insights on trading psychology.
Yeah, good to have you here. So let's begin by telling people a bit more about kind of who you are and what you do these days.
First and foremost, my name is Pat Bailouni, as I was introduced. These days I run an education and performance coaching business. And specifically, I work with institutional and retail traders, and I help them overcome their psychological challenges and help them achieve funding goals. And I also trade myself as well. I've been trading for the last 6.5 years. And maybe I'll share a little bit of my journey, how I got into trading, how I got into what I'm doing now as well. So like I mentioned, I started trading about 6.5 years ago. And the initial curiosity for me came from my uncle who gave me that initial curiosity to check out the markets. And I did. And I pretty much went on to LinkedIn and found myself a free LinkedIn trial. It was a 30-day trial back in the day. And I outreached as many people who had Forex or trader in their bio, asking for mentorship from them. So 6.5 years ago, I was that annoying guy cold messaging people on LinkedIn. And long story short, I ended up finding a mentor. A gentleman named Mike was generous enough to help me out initially. And he taught me a little bit about his strategy. And I actually used that initial strategy that I learned from Mike to pick up my first round of investment. It was a $100,000 investment. And this was before I even knew about prop firms. This was a while ago now. And I ended up picking up that round of investment, a private round of investment. And I traded that strategy initially. However, the initial increase in capital for me was quite a lot at that time. That had a lot of psychological challenges on me. And I didn't know how to manage the extra amount of capital. I had a lot of the common psychological challenges like FOMO, revenge trading, all those types of things, all those challenges that come with trading larger capital at the time. And long story short, I ended up losing that initial round of investment. We had a drawdown buffer built into the contract. I ended up hitting that, and I lost that initial round of investment because I didn't know how to manage my psychology. And that was a very difficult part for me in my journey. I had a lot of unrealistic expectations of myself, a lot of fantasies around trading that all got crushed in that moment. I didn't take that loss of investment very well. And it left me, really down at the time. Now, in that time, I was always studying human behavior and psychology because I loved it. I loved the markets. I loved the human brain. But it was losing that investment that was the impetus for me to go even deeper into the studies. And I went and did a mentorship under Dr. John Demartini, studied a lot of his stuff. And I was learning more on the human brain to help me become a better trader at the time. So I started to create principles, teachings, and stuff to help me become a better trader. And then I was part of communities and people asked me for help, one-on-one coaching, that type of stuff. So I started to coach other traders and teach them what I was learning on the human brain, human psychology, and trading psychology. And that just started to grow very naturally. But it grew into the education and performance coaching business, master your trading mindset that I have now. I've consulted for prop firms. I currently do consult for prop firms and for education companies. And I help them and their traders, again, overcome the psychological challenges they have and get funding. So that's really a bit of my journey and my background and how it naturally progressed.
What was the change that helped you to become profitable in your trading? Was it a mindset shift? And how did that happen exactly?
Even though I talk a lot about trading mindset and trading psychology, and I do think that's such a big component. I think it's 90% of the picture. I don't necessarily think mindset is gonna make you consistent if you're not trading a strategy that resonates with you. So I know for me personally, I've traded a few different strategies and I haven't had consistency with a lot of those strategies because those strategies didn't resonate with my personality. They didn't resonate with my lifestyle. So actually for me, what I found was when I found a strategy that I could put into a very simple mechanical trading plan, right? And I could have a step-by-step procedure of how I would execute in the market. That's actually where I found consistency in the market. The thing I consistently see with those who have consistency is those who can consistently execute on a clear edge are those who end up getting consistent results. Consistency have come for us when we have created a system, a trading plan, or we've learned a system or we've learned a strategy and we've created a clear step-by-step trading plan from it that we're able to just go off and execute on. Now, of course, the psychology comes in after you have that clear system, because once you have a step-by-step system, it's going to be two emotions that are going to take you away from executing on that. It's going to be fear and greed. If you're fearful in the market, you're not going to execute when the market presents opportunities. If you're greedy in the market, you're going to try and go away from your plan and try and capture profits that aren't there to be captured. So once you have that trading plan in place, it's now about mastering your trading mindset and learning the self-management tools to be able to manage your emotions so you can stick to your trading plan. But I know for me, and I know for a lot of traders, that consistency actually came from when they created a step-by-step trading plan, and then any of those psychological challenges that take them away from that trading plan, they learned how to regulate and how to manage. But that's at least been my experience.
I'm sure people are going to ask kind of what that trading plan is like for you. So what do you trade? What do you focus on these days in trading?
So for me, the system that I really have settled on at this point in time, very simply, I look for, if we're going to delve into it, I look for an area of value on the higher timeframes, like a daily chart. I look for a support and resistance, or a complete structure, or a complete pattern, and then I look for an indication on that higher time frame that we're going to get some sort of move. So like a retrace candle or a strong confirmation on the daily chart. And then I drop down to the lower time frames. I look at the 4-hour, hourly, and 5-minute chart. And I'm looking for, on the hourly chart, certain indicators to be met, certain entry criteria to be met. And then there's an additional indicator or entry criteria. I look on the 5-minute before I put risk on in the market. So I trade a top-down higher time frame analysis, 3-chart layout on the lower time frame, and I use indicators, I use support and resistance, I use patterns, I use price action. I kind of put all that stuff together to create confluence to a trade idea. So that's really how I trade. And again, like I mentioned, it's very easy for me to create a system from that, a step-by-step system of this is exactly what I look for. And what that means, Etienne, is every time I come to the market, I'm trading an edge. I'm trading the same way, because some people don't have that system and they come to the market and they trade based on how they feel. And as a result, they're not executing an edge over a large sample space. But yeah, that's how I trade currently.
So when it comes to mindset, where can people start to learn that stuff? Because there's so many different topics. There's over trading, of course. It's going to be, like you mentioned, consistency. There's going to be kind of fearing losses. What do you start with all this, and how do you get to become a better trader and have a better mindset for trading?
Well, if I was to suggest one thing, this would be what it would be. I've created this idea, or I've synthesized this idea from my studies and from my learnings, that you want to differentiate between, or you want to have an awareness of what type of decision you're making. Okay, there are, to summarize it down, there are 2 types of decisions you can be making as a trader. And I really learned this when I was working with one of my most successful clients, individuals trading a lot of capital and making a lot of money from their trading. This to me became very clear when I was observing what this individual was doing. But there are pretty much 2 different types of decisions you could make. You can make an outcome-based decision, or you can make a process-based decision. So when you go to the charts, when you go to execute, if you're making a decision based on what you think the market's going to do, based on what you think the outcome of that position is going to be, and we create these ideas, these fantasies, these expectations in our mind, in what I call the virtual market. Our mind is the virtual market. So if we're making a decision based on what we think the market's going to do, what's going to happen? Because nobody actually knows what's going to happen next in the market. So if we're trading based on what we think is going to happen next in the market, we're going to be trading based on these expectations, these fantasies. And that's going to leave us highly susceptible to being emotional in the market. It's going to lead us susceptible to not trading our edge, not trading our trading plan. The other type of decision we can make is a process-based decision. It's when we're looking at what the market's communicating to us and we're making a decision based on, is the market aligning with what's in our trading plan, right? Is the market aligning with what's in our processes, et cetera, et cetera. So if traders can build up the self-awareness before they take a position of, am I making a process-based decision? Am I taking this trade because it aligns with my trading plan? Or am I taking this trade because of what I think is going to happen next in the market? If a trader can build up the awareness before they trade of which decision they're making, stick to process-based decisions and avoid taking outcome-based decisions, I guarantee you that will get a trader, let's say 80 to 90% of the way towards consistency, assuming the trader has a trading plan and has an edge. Okay, does that make sense? So if a trader can go in there and differentiate between an outcome-based decision versus a process-based decision, all right, if a trader can do that before they execute in the market, they're going to have much lowered emotional volatilities. They're not going to be angry and they're not going to be resentful if they take a loss because they didn't have unrealistic expectations before that trade. And they're going to give themselves permission to just execute over 100 trades, over 1,000 trades, let their edge play out. And it's ultimately the consistent execution of an edge on a trading plan, or the consistent execution of a trading plan that leads to consistent results. So that trader is then going to have consistent results as a result. I hope that makes sense. But if I was to suggest one thing, it's about building up self-awareness of what type of decision you're making as a trader and learning to ground outcome-based decisions and learning to go back to process-based decisions and sticking to those.
That's all good and nice, but most traders are going to be stuck in a cycle where they don't even spot that. They cannot even stop before they take a trade to think about that. And even if they force themselves to do it, they're going to have some emotions that will tell them to get in the trade because they can miss it and stuff. So how do you still do that when you're kind of stuck in that cycle and you don't have time to think before you take trades?
Okay, that's a really great question. Now, there are two things here. First and foremost, I created a free tool to help traders build up the self-awareness towards that. So the more and more you document that and you go into this tool I've created and you write down, okay, what are my expectations before this trade? What's literally in my mind? What am I thinking before I take this trade? And the more and more you document it and you learn to have an awareness of your expectations and thought process before you get into a trade, it's like a muscle, Etienne. It's like going to the gym every day. You start to build up that self-awareness and you start to learn to be aware of your decisions before you take a trade. Now, is that going to happen straight away? Absolutely not. It's going to take time to build up that muscle. It's going to take time to build up that awareness. So the first thing I encourage traders to do, it's very simple, is you literally get a pen and paper out and write down what expectations you have from this particular position and what you think the market's going to give you. And if your expectations are anything but, so if you have an expectation of what you think the market's going to give you, where you think the market's going to go, for example, I think your dollar is going to go up, or I think this is the trade that's going to help me get my funded account, right? Those are all outcome-based expectations. If you're going into the trade with the expectation of, I don't care which direction this position goes, I don't care if it goes up, I don't care if it goes down, I'm executing on this position because it aligns with my edge. I don't know if I'll win on this individual trade, but I know over a large sample space, I'll be profitable because I'm executing on an edge. That's a process-based decision. So the more and more you document it, the more and more you train that muscle and you build up that awareness. And over time, you'll develop the awareness to then catch yourself in the moment. Okay. Now, another thing on top of that, a deeper level than that, the expectations we create come from subconsciously stored information. And what I mean by this is if a trader has had experiences in the past of this trade has been very painful and my losses have been very painful, that's going to store in the subconscious mind as a negative event, as a painful event, as a bad event. So too, if that trader has an experience in the past of making a lot of money on a particular position and they see winning is very good in their mind and they associate a lot of pleasure to winning, that's also going to store in the subconscious mind. And that subconsciously stored data of good and bad, winning and losing is bad, winning is good, is then going to drive expectations in the real time. So the more a trader actually goes back to those moments of perception and neutralizes them, they go back to their losses and they ask themselves, in that moment, I'm initially seeing this event as an all bad event. How did it actually serve me as a trader? How is that a benefit to me? And they start to see the other side of that loss, and they realize that losses keep them teachable, losses keep them open, losses give them accountability to stick to their trading plan. Losses help them grow as a trader because now, they're more teachable and they go off and learn and they do more back tests. They have more accountability to back test and more motivation to back test. And they can start to see the other side of losing in very specific moments. What starts to happen is they start to rewire their subconscious mind, and they no longer are seeing losses as an all bad event. They realize there are actually some benefits to losing. And so too, if they go back to their very pleasurable wins and they see the drawbacks of those wins, and they realize that winning takes them away from their trading plan, winning puffs them up and they're more likely to project low quality setups into the market, winning makes them less teachable, and they start to see the drawbacks of winning, what they start to do is they start to rewire their subconscious mind. They start to take winning off a pedestal, losing out the pit, and they start to see the outcome as more neutral. Then when they go to the market, they're going to be less likely to project expectations, and they're going to be more present with the market. They're going to listen to the market, and they're going to make more process-based decisions. So in my program, I teach traders how to actually go back to those moments and address a lot of the pain they've had in the previous experiences and a lot of the pleasure they've had in previous experiences, because those painful and pleasurable experiences drive unrealistic expectations in the moment. They take you away from your trading plan. They make you act out of fear and greed as opposed to out of process-based decisions from their trading plan. And the more they neutralize that subconsciously stored stuff, the more brain clear they are, the more present they are with the market, and the better decisions they make as a trader. So to answer your question, it's two things. Build up the self-awareness in the moment before you take a trade by writing it down or documenting it in the free tool. And two, you have to go back and address the subconsciously stored baggage of good and bad towards winning and losing. I come from the personal belief, and this is after my studies in psychology, human behavior, and a trader myself, that it's those associations as winning is good, losing is bad, that actually kills traders' consistency. The traders who can disattach from the outcome and stick to their processes are those who end up becoming consistent, in my opinion, and from what I've seen.
That's interesting because a lot of people feel, like you said, bad when they have a loss and they don't know how to fix that. They might have a few losses and they stop trading, and they might kind of come through a trade that was good, but that they lose and they're pissed off about it. They stop trading for a while. How can you avoid that?
Again, it's all about awareness. I believe trading is all a game of awareness. I guarantee I do this in my program all the time. And when I work one-on-one with traders, we go back to their most painful losses, and I ask them a very simple question: how is that loss a benefit and service to you? Right? Because initially they're seeing it as a terrible event, a very painful event. But the moment we go back to those losses, and believe me, I've been through this myself. I'm not saying this as someone who's never traded or lost funding or lost money. I've lost a lot of money in my trading career, and it's been very painful to me. But I'll be the first person to admit that those losses have been the catalyst for an enormous amount of growth in my trading and in my life as well. So you have to go back and you have to start rewiring your perception towards what losing is and what winning is. Because if we go back to those moments that we label as very painful losses, we go back to the moment, we get present in that moment, we ask, how is that a benefit to us? You'll see the other side. You'll see the growth that came from it. You'll see the new levels of accountability. You'll see the new levels of teachability, the openness to learn. It makes us aware of things we have to refine, and it's all often the growth catalyst. So again, it's work, right? But the more you go back and you start to see that losing wasn't actually all that bad, it had benefits too, you start to rewire your perception towards losing. You start to rewire your belief of what losing actually is. And losing is less painful in the future, or it starts to become less painful. Now, does it mean you could be completely unemotional after every loss or after every win? No, I don't think that's possible, because we all have that survival instinct. But you can start to dampen down your response to winning and losing. So you go back to your processes, you go back to your trading plan. That's really what it's all about.
What about prop firms? Because like when you trade someone else's capital, there's the pressure of maybe potentially losing that capital that comes into play. You got to meet the target and not go beyond the risk parameters and stuff. How does that come into play? How can you be more comfortable with these kinds of pressures when you trade a prop firm account or an investor's account?
Yep, it's the same thing. I with that initial round of investment that I picked up, I had an enormous amount of guilt when I lost that round of investment, right? Because I had an emotional attachment to the individuals that I was taking that money off, right? It's a little bit better now with the prop firms. It's a little bit more unemotional. It's a little bit more cutthroat. It's a computer who does it. But I had a lot of guilt over losing the money. And again, it's the same exercise. It's about going and finding how these events serve yourself and other individuals. But there's another thing here, Etienne, that I work a lot with traders who want to get funded through prop firms, who have got funded and want to scale that up. And what I always encourage traders to do is to refine their trading plan and to add some sort of risk management protocol. So I have a very particular risk management protocol that I teach my traders that, let's say, for example, the drawdown buffer is a 10% drawdown buffer, right? And when you go negative 10, you lose the account or you lose the funded challenge. I think every trader should have a risk management protocol where they slowly scale down risk. So let's use an example here. Between 0, break even, and -5, maybe the trader risks 1% of capital, for example. So between 0 and -5, you're risking 1% of capital. Between -5 and -0.75 or -7.5 drawdown, you half your risk. So instead of risking 1%, you're now risking 0.5%. And then between -7.5 and -10, instead of risking 0.5%, you half that again, you risk 0.25%. So as the trader gets closer and closer to hitting the drawdown buffer, they're scaling their risk down. And what that protocol allows you to do is it pretty much doubles, if not more than doubles, the amount of trades losses you can take before you hit the drawdown buffer. And what traders are doing is they have a process in place. They've got a risk management protocol to help protect their psychology. So the more they go into drawdown, right, realistically, the more emotional they're going to get. So the more you scale down your risk to protect your psychology. So again, you can get back to your trading plan. I believe what a trader needs to do is they need to protect their psychology so they can always go back to trading their trading plan. They can go back to their rules. So you want to do anything you possibly can to mitigate the emotional volatilities of losing and winning so that you can go and trade your trading plan. Because it's, again, fear and greed, two things that are going to take away from trading your trading plan.
If you do that, then you're going to have a longer time to be able to get back on track, get back positive in your challenge. How soon do you bring the risk back up to normal levels or close to there?
Yep. So let's say between 0 and -5, you're risking 1%. If you go into, if you go to -5.5, you're now risking 0.5%. The moment you get back between that green light zone of 0 to -5, you're now risking 1% again. Now, a lot of people say that, but then it's going to take me longer to get back up to the other side. That is true, but you're also protecting your psychology. Again, you're doing everything you can to protect your psychology, so you're making process-based decisions. Because I see a lot of traders, they get deeper into that drawdown, and then now because the more pain they have when they're in the drawdown, the more they're going to create this fantasy to disassociate from the pain to get to the other side of that, and the more emotional their trading becomes, the less process-based they become. So again, you're doing everything you can to protect your psychology to go back to your trading plan. But then I also encourage traders when they're in the positive, right? Some of these funded accounts allow you to, if you're in the positive, if you end the month on the positive, you have a free repeat on some of the firms. So I also encourage some traders, if you are in the positive, do it responsibly, but scale up your risk incrementally so you can hit the targets, just as long as you stay in the positive. But then there are also other prop firms out there that have 6 month or 12 months time frames. So you have to look at your strategy. I used to work as a performance coach for one of these prop firms, and they had a lot of individuals who came into those challenges that failed the challenge, and a lot of traders failed challenges. So you have to look at your trading, and you have to recognize if hitting 8 or 10% in a month isn't reasonable for your trading. Maybe look at some of these other prop firms that allow 6 to 12 months for hitting the target that they set. So you have to be really realistic about going into these prop firms, about which ones you go for. Maybe look at alternatives that allow you to have more time, et cetera, et cetera. But yeah, a lot of traders, they don't have a proper strategy. They don't have proper risk management. They don't have the proper psychology. And they just go into these prop firms and they continuously lose the challenges, and they lose a lot of money doing that. So make sure you're not that individual. Go back, ground yourself, create an edge, master your psychology, create a game plan before you get into the prop firm. Go into a prop firm that resonates with your strategy, and be responsible about the way you go for prop challenges. That's my piece of advice.
Definitely good advice there for sure. So what can people find you then, connect with you or reach out after this interview? Where can they see more of what you're doing?
Well, I have a YouTube. I've got probably close to 250 videos on that YouTube. I do trading psychology lectures on that YouTube, where I provide what I think is a lot of value in terms of all the different and important topics on trading psychology. So I'd encourage traders to check that out. The YouTube, there's a lot of free value on that YouTube. Go through the videos, go through the most recent videos, especially go through the trading psychology lectures in particular. There's a lot of gems in there that will help with your trading psychology. So I'd encourage traders to check out the YouTube. I also have an Instagram page that traders can check out, Master Your Trading Mindset. But those would be the two places. The YouTube is my name, Pat Bailouni, Trading Mindset. And the Instagram is Master Your Trading Mindset. I think, Etienne, you'll probably put those links in the description below. I'll send those through to you.
So I appreciate the advice you shared here for my listeners and my viewers. That means a lot. And hope we can catch up pretty soon, discuss more mindsets, and see how you evolve in trading also.
Thank you so much for having me on. Thanks for listening in, guys.